Wall Street Journal has a piece today that I'm guessing is completely miscategorizing the subject. Investors are souring on big tech, and they talk about stretched valuations after a very substantial run-up. I would not debate the substantial valuations. I would not debate the idea that some people are taking a second glance at their tech exposure, but I have to wonder how much of that is purely because the Nasdaq's done like 3% this year, as opposed to its more recent 20-30% up years that we've been seeing. Is it more what have you done for me lately, Paul, or do people have genuine concerns here?
No, I think it's more what have you done for me lately. Ultimately, on the valuation front, no one's going to argue with the sentiment that heading into the beginning of this year, tech had performed extremely well and the stocks were highly valued. Some of these shifts that are discussed in this piece, which I do feel are real and have been happening over the course of the first few months, which include putting more in the way of utilities and consumer staples. Those are sectors of the market that tend to have less economic volatility in times of uncertainty, and usually you will sometimes see during times of market challenges that more money is poured into the utility sector or consumer staples. Think, Colgate-Palmolive or Procter & Gamble on the consumer staple side of things, NextEra Energy on the utilities. Those companies are going to have a much more predictable revenue base than something like Tesla or others out there. So I'm sure that shift has occurred to some extent. And then the international one, that's a big play too. It seems like there's been a lot of piling into international equities when you have the policy uncertainty here. But
here's the reality. Investors, retail investors especially, but investors across the board chase returns.
Yes.
And we're seeing that play out. A net $7.1 billion this year has flowed into tech-focused exchange-traded funds. That's according to Morningstar Direct, while institutional flows into funds that try to buy stocks at a discount, so value funds of some form or another, saw an inflow of $25 billion, while international ETFs logged an inflow of nearly $70 billion.
Exactly.
Go take a look at how that performance is stacked up. Your international has done double digits, your tech has done low single digits, and your value stock somewhere in between. And so that's the only conclusion I have. Are tech investors souring on tech names, or investors in general souring on technology stocks? No, it's just what have you done for me lately? They're out there chasing returns, and the returns this year have not come from the United States and certainly have not come from most big tech companies. Might there be a little bit of something here on, some investors souring on Tesla? Yeah, I could see that. That could be real. Could you have some investors saying, on both sides of the political spectrum, by the way, souring on that one company? Could be, but quite honestly, that's not how most people invest.
No, Apple has had some share pressure too, which is sort of understandable just because of their reliance on China. But ultimately, that's not what investing is about for most people.
Again, I bring up the Tesla thing because how many people that are frustrated with Tesla owned Tesla shares in the first place? Or own individual stocks at all in the first place, right? The vast majority of people invest through their 401k, have no option to even buy individual stocks, and are probably not shifting things much at all. The shifts that you are seeing, I don't think are driven by fundamentals or people taking a real hard look at their tech exposure and saying, whoa, am I up over my skis? I think in most cases, it's people saying, my tech's not doing as well as it did for the last few years. What's doing well this year? Oh, that foreign stock seems to be going quite well. Why don't I try that out instead?